Welcome to Market Monday from the investment team in the trust department at the First National Bank. Now, we normally begin each session with a review of the economy and important numbers. We're going to do that here again, but we are going to depart from the normal playbook by, minimizing the time we're really talking about asset classes, equities and fixed income, yields in particular, and talk about economics 101, because the economy has just shown us some very interesting data as of last Friday's non-farm payrolls report. So getting right into this, the non-farm payrolls report came out. The expectation was overwhelmingly higher than the actuality. So we had the expectation, the analyst consensus, over many analysts polled on this, expected an average of 75,000 jobs to have been created in the prior period. We got 22,000. That's in the entire economy, in non-farm sector. So what does that mean? That means that, growth in the labor market is sharply lower than what was expected. That's actually more than 2 standard deviations below the average expectation if we blew that up and took a look at the distribution. And what's worse is prior periods, in particular June's period, was revised down into a negative, manner. So what does that mean? That means that, the labor market actually has been growing more slowly, decelerating more quickly than what the majority of economists believe to have been true. And that gives us an insight that, hey, we have to watch out and see what's going on here with the economy, because this is a signal that the labor market may be in fact weakening, and we may get a revised number down again, as we get the next month's number or the next month's report. So what are, the implications of a slowing labor market? Well, stepping back to monetary policy, the Federal Reserve has a mandate to do 2 things, and only 2 things, by the way. They've overstepped their bounds in a number of areas, but they have 2 particular mandates. One of them is to maintain the labor market, and the other one is to maintain price stability, in other words, not let inflation get out of hand. And we can argue that they've not done a great job at either one of those, given that inflation is stubbornly high and the labor market appears to be weakening. It's complicated by the fact that Washington is in there making pronouncements, so to speak, about what the Fed should, quote unquote, or shouldn't, quote unquote, be doing, when in fact, their approach is scientifically based, not necessarily partisan in any way, but designed to try to best balance those 2 competing goals. And those goals are competing. Whenever you lower rates in order to stimulate the economy, in order to improve the employment situation in the labor market, by definition, expectations are that inflation will rise as a result. And it makes sense. When they lower the cost of money, which is short-term interest rates, one would think on the surface that all yields are going to go down across the yield curve. In other words, the yields are going to go down over the course of this whole curve. That's not the case. What happens is, short-term money is based to the Fed's overnight rate to some degree. Once you get out past like 8-9 years in average duration on the treasuries, you're starting to get an inflation risk premium that's added to the situation, and inflation expectations are actually going up. These rates are not pegged as closely to the overnight rate, precisely because you don't want to loan your money to the government for 10 years or 20 years and then have your purchasing power erode. So large investors are going to demand higher yields than whatever is current now when they think inflation is going to remain high. And that's what this yield curve is telling us right here. This is where we were at a year and a half ago, almost 2 years ago. If I zoom in, make it closer, this is where we were at the beginning of the year, and yields have come down. That is true. However, we are seeing the yields sharply rising as you move out the curve, and this has implications. If you have a flexible rate mortgage, your rate's tied down here somewhere in a lower duration, benchmark rate. If you have a 30-year fixed rate mortgage, that is tied to the 10-year note. And if the 10-year note winds up going up because inflation expectations get too hot, because the Federal Reserve does inappropriate monetary policy and cutting the rate at the wrong time, This could be problematic in the real estate market. This could be problematic across credit markets in the United States. We'll have to wait and see what happens, but a misstep here has big consequences. So we got to watch that. And the Fed is meeting next week, and some of the inputs that they're looking at are, all right, this unemployment rate remained, relatively stable. It ticked up 1/10 of a point. The non-farm payrolls was much weaker than expected, so that's something that's a key deciding factor for them, and it may open the door to the appropriateness of actually cutting that rate now, although we here in our team don't believe so yet. We think that this number here is still showing an economy that's running on a relatively hot level, and if that backs off to close to 5% or closer to 5%, that would justify the rate cut much more than just the initial slowing of the labor market. Perhaps it's a blip. Perhaps we do something now and inflation takes off, which only makes this worse rather than better. So we think the prudent approach would be wait and see right here. We don't think that's what's going to happen, though. Purchasing producer price index comes out in a couple days, and that's expected to come in basically flat. When you take out, food and energy, which are volatile, it's going to show a 0.2 of a point contraction, but that's still 3.5% is what the expected inflation number is on producer prices. The following day, we're going to get consumer prices, which is expected to, remain the same in the core consumer price index when you strip out volatile stuff. If you don't strip out the volatile stuff, the expectation is inflation rose by 0.2 of a point. So this is making the deliberations at this meeting that the FOMC is having on rate cuts really, really consequential and probably pretty contentious. They're getting pressure from Washington, they're getting pressure from other constituencies and markets, and yet their mandate is to maintain balance, not take a side. And it seems like we live in a world now where everyone's taking a side. These guys they have their work cut out for them. We'll have to see what happens. We're going to get more labor market information toward the tail end of the week. Sentiment information is hugely important for figuring out the context of what's going on in actual demand conditions, what's happening with sentiment. Do business leaders and do consumers see risk on the horizon? Are they fearful for their jobs? Are they slowing down spending? Those things could tip the economy into recession, and again, the Fed has to avoid that as well. That impacts the labor market. So it's exceedingly complex what they do. Hopefully they get some credit for that. Going into the retail sales numbers that are coming out, that's expected to show, a decline on the headline number. It's going to show an increase when you take out automobiles and an increase when you take out automobiles and gas. So what that's telling us is the broader spending pattern of, the public is actually starting to decelerate. And this is going to be problematic as well if that's true. GDP is 2/3 composed of consumer spending, and retail sales is a direct, linked instrument to measure consumer spending. If that's declining, it's likely that GDP decline is quick to follow or contemporaneous with it. So we're going to be watching this stuff too. So is the Fed. We think this is probably a down to the wire decision, whereas sometimes, for the most part, it's a situation where they have a pretty good idea where everything is, and they know coming in into their meeting what the likely outcome is. We think that meeting is going to be pretty contentious and filled with debate, and it's probably going to have some dissenters however they rule it, whether they cut, whether they stay, but it will be interesting, and it will move markets one way or the other. We get production, and that's expected to show no growth, and then we get this rate decision. What's also important is we're getting what's called a dot plot, and a dot plot is what the Fed thinks is going to happen over the next, few years and longer term. And it's interesting when we compare the new one to the last one, or the last meeting to the where they gave a dot plot and the one before it, you'll notice something interesting happening. The preponderance of the rate forecasts, the bulk of them, kind of either were flat or went up. They went up over the shorter term. So it represents a pretty significant about face if they come in and have lower expectations for various rates, or for the rate over various periods than they did at the last meeting. It's an about face, and it does suggest, hey, we didn't really understand the situation that we were in. Or, conversely, do they hold the line and say, hey, no, we expect, inflation to remain higher, and we expect to have to keep monetary policy tight. That'll be really consequential, and this dot plot, when it releases, is a big market moving number in the bond markets and potentially the equity markets as well. Players are positioning for what they see the likely macroeconomic conditions to be over the next couple of years based on this forecast, as the Federal Reserve is in probably the most educated place to make these guesses, which is all these dots are really, is each individual, FOMC member's guess as to what the rate will be at that time. However, coming back to all of this, monetary policy ultimately is the lever that dictates the growth of asset prices or decline, potentially, or at least I shouldn't say dictates, but influences, and certainly influences the cost of money on the short term, which, if you think of a kind of a seesaw, it's going to lower the rates at the short end, but because of inflation expectations going up concurrently with that, it's going to raise rates at the long end of the curve, and that could potentially have some implications. So where do we stand in terms of stocks? Market's basically trading up on all-time highs. It's doing well. This type of a pattern is something that we like to see. It suggests that, stock is being accumulated up near all-time highs. And if they do wind up cutting rates, we can probably expect to see a rally, at least in the short term. But is it going to be durable? We don't really think so, because the implications of a rate cut suggest economic weakness on the horizon. Equity prices tend to discount events out a year to 18 months, so we're forecasting turbulence going into the end of the year. As far as the longer term, our outlook is going to remain relatively the same. We don't want to change our long-term plans based on short-term expectations or turbulence. In fact, turbulence may be buying opportunities. The yield curve has come down a good bit. However, these rates are still pretty good for treasuries, 3.5, for the 5-year, 4-year, or 10-year paper at 4%, and so forth. If we go into corporate bonds, thought I had that in there. Let's get the yield curve in there. Okay, you're getting a little bit over 4% over 5 years. 10 years, you're getting 4.8, and further out on the curve, you're getting up to about 5.5 at the vertex of this thing. So, if you're an income investor, these rates are still pretty solid. If you're looking for more rate cuts to lower the value of your bonds, though, or to increase the value of your bonds, you might be in for a shock if you're owning longer term paper, which is why we tend to keep shorter duration bonds. In other words, bonds maturing in the next couple of years, 5 to 10, let's say. We like to keep within that time frame when we're expecting inflationary conditions. And, regardless of weakness in the economy, there's nothing to indicate that inflation's out of control yet. Want to close with this and come back to it. There was a lot of verbiage about, what happened in the labor market report on Friday. The long-term average of non-farm payrolls is about 125,000. The latest report came in at 22, which is pretty low comparatively. But the moving average of the past year, I've run a 1-year moving average of this non-farm payroll. In other words, we take the value each time and take the average of it for the prior 12 months. That's been ticking down since the peak right around the end of, right in the middle of 2021, after the hiring, after COVID kind of tapered off and the restart of the global economy. And it's been trickling down, and it's in at 116. So 116,000 jobs is the 12-month moving average, which is just below the long-term average. So do things look really, really dire right now? We'd say not really. So let's not get all nervous just yet, just because there was a bad payroll print. Let's not jump the gun, and certainly let's not change long-term plans that were made, with the bigger picture in mind, which is overwhelmingly positive. We want to stay to our plans. If you have questions, if you want to talk, we're here. Thanks. Hope you found this useful. Have a great day.